Large cap, small cap, debt, equity or sectoral. When you step into the world of mutual funds, the choices can be overwhelming. But before you pick a specific category, there is a much bigger decision you need to make. Should you go active or passive? Hi and welcome to Geojit Spotlight. Today, we are settling the debate between active and passive mutual funds to help you decide which one deserves a spot in your portfolio. First, let's clear up the jargon. What exactly is the difference? Think of an active fund as a ship with a very hands-on captain. In these funds, a fund manager actively manages the portfolio. They are constantly researching, tracking, buying and selling investments. Their goal? To make specific choices that will generate higher returns. On the other hand, passive funds are exactly what they sound like. Here, the fund manager doesn't make discretionary choices or try to outsmart the market. Instead, they simply copy a popular index like the Nifty or Sensex and invest in the exact same stocks in the exact same proportion. Active funds take more risk to try and beat the market, while passive funds aim to mirror the market. So, why would you choose an active fund? Here are 3 main reasons. Number 1. You want to beat the benchmark. If you are an aggressive, ambitious investor, your goal isn't just to match the market average, but to outperform it. Active funds are designed for you. Number 2. You trust the expert. If a fund manager has a stellar track record of navigating market ups and downs and generating returns beyond index, investing in their active fund allows you to leverage their expertise and experience in anticipation of their repeating the outperformance in the future as well. And number 3. You want to capitalize on a specific theme or a market cap curve. Fund houses often analyze market conditions and launch funds targeting specific sectors like banking or technology or a mid or small cap. If you have a strong conviction that a certain sector is about to boom, active funds allow you to jump on that bandwagon with the expectation of getting returns beyond what could be delivered by the sector index itself. Now, let's look at the other side of the coin. When should you opt for passive funds? First, if you are a conservative investor with an equity approach, active funds can be volatile than the index they are benchmarked with. If you prefer an approach that is aligned with the movement of a particular index of your interest and want to avoid the risk of fund manager making wrong call, passive funds are a safer bet. Second, you are playing the long game. If your goal is long-term wealth creation, say growing your portfolio 5 times or 10 times over many years, and you believe in the overall growth of the Indian economy and you don't want to try index-beating options, by investing in a passive fund tracking the Nifty 50 or Sensex, you can simply ride the market's growth wave. And finally, you trust the index. Sometimes you might be confident about a specific segment like the Nifty Midcap 100. In that scenario, it makes perfect sense to buy a passive fund that replicates that specific index rather than trying to pick individual winning stocks within it. So, which one is better? The answer depends entirely on your risk appetite, your timeline, and your financial goals. Many smart investors even choose a mix of both to balance stability with high growth potential. That's all for today. Subscribe to Geojit Spotlight.